Money on my mind, looking for a dime. James Lock in the house, gonna help you shine.
Welcome everyone. Welcome to the Pool Lock YouTube channel. I'm James Lock. Today we're going to answer some of the Ask James questions of the day. First question is from Dan, and he asks, you've said that there's 3 types of mutual funds, but I think there's more than that. What do you think about foreign funds or balanced funds, for example? All right. Well, you definitely caught me, right? I guess there are different combinations and permutations of funds. Most foreign funds are a subpart of stock funds. So if you break it down the stock fund world, you can get into, large company stock funds called large caps, right? Small company stock funds, small cap. Growth funds that have momentum, maybe a higher PE ratio, right? Value funds that are undervalued, maybe higher in dividend yield. International funds, foreign funds, right? Different subcategories within the broad company or category of stock funds. Now, within the bond market, you can have government bond funds with government bonds, corporate bond funds with corporate bonds, municipal bond funds with municipal bonds, or blended bond funds that have all the above. And as you've said, you can have a balanced fund, right? That has some stocks, some bonds. It's a combination of those 2 categories. So really what I try and oversimplify it here sometimes, right? Because, you're watching this, you're not necessarily taking notes or anything like that. But the bottom line is I really try and keep it simple kind of with those categories when we talk about it. But you're right. There are subcategories within each one. And sometimes there's combinations of 3, all of those categories. Now, when we're talking specifically about retirement income, which is what this channel is all about, these different fund types can play very different roles in your portfolio. For instance, those foreign funds that you mentioned can provide some geographical diversification, but they often come with currency risk that can create additional volatility in your income stream. Now, that's something to consider carefully when you're depending on that income for your monthly expenses. Balanced funds, on the other hand, can be, attractive for retirees because they automatically manage the stock to bond allocation for you. But here's the catch. You're giving up control over that allocation. Maybe you want to be, more conservative with 70% bonds and 30% stocks as you get deeper into retirement. But that balanced fund might maintain a 60-40 split regardless of your changing needs or market conditions. So yes, you're going to see more and more fancier combinations that come up at different stages. For example, now we also have exchange traded world, right? There's funds there. You have like Bitcoin ETFs and things like that. They're like funds, but honestly, for folks approaching retirement, I'd be very cautious about putting your income generating money into something that volatile. Bottom line, there's always newer things coming out, but they all fall into one of those general categories: stock funds, bond funds, or the one I haven't really talked about yet, money markets. Now, we've talked about bond funds and stock funds, right? But let's jump into the money markets. It's essentially like a bank account, more or less. It acts like that. Yes, people don't really even think that money markets are a type of mutual fund, but they are. So again, it's a pooling of investors' money, just like stock funds, just like bond funds. But now what they do is they have what's called short-term paper in there. They make 7-day loans, 30-day loans, maybe 90-day loans, the longest. They loan money to the U.S. government by buying T-bills. They loan money to corporations, high investment grade corporations, AAA rated corporations, for 90 days or less in short-term loans. So because they're so short-term, they're very safe. Chances are a company's not going to go from being AA or AAA rated to bankrupt in 90 days. So they're considered to be extremely safe, and they pay interest. That's the good news. The bad news, though, it's unlike a portfolio of individual bonds, right? The income is not fixed. So essentially, or especially if the Fed lowers short-term interest rates, the income that gets paid out, the interest, is going to drop significantly. So if somebody's counting on this for retirement income, they usually aren't the best option for your core income needs. The variability in income that can really throw off your monthly budget when you're on a fixed retirement income. It's a great question about different kinds of mutual funds. And as always, if you'd like to send in your questions, you can do so by emailing them to poollock@poollock.com. Moving on to our second question. We have an email from Keith. He says, how are exchange-traded funds different from mutual funds? All right, that's a good question. ETFs are basically very much like mutual funds. All right, they're diversified pools of investors' money, but they're traded as a stock. Now, what does that mean? Unlike mutual funds, you can only buy and sell at the end of the day. So if you sell a mutual fund today and you think you're getting $14 a share for it and the market drops, well, you're going to get out of it whatever it's worth at 4 p.m., the close of business, Eastern time, right? If it drops to $12 a share, you may put your sell order in at 1, but you're going to get less than you think. Now, of course, that can go the other way, right? You can get more, but they're not traded intraday during the day. Exchange-traded funds are traded like a stock. So that means that you can trade them during the day, so you can get more exact pricing. Now, you can put in stop losses on them, right? So if it clicks below a certain level, it automatically gets sold. Now, for non-IRA accounts, you can borrow against them and take margin debt, right? That's basically what an ETF is. Now, for those of you approaching retirement and focusing on income, this intraday trading feature might seem appealing, but let me caution you, it can actually work against you or against your long-term income strategy. When you're retired and depending on dividends and distributions for your monthly expenses, the last thing you want to do is get spooked by the daily market volatility and make emotional trading decisions. That real-time pricing can become a double-edged sword if you're checking your account balance every day and reacting to short-term market movements. The ETF's claim to fame is that it should be lower expense than a mutual fund. And the answer is sometimes yes and sometimes no. The reason the reputation came up was because the first couple of ETFs we ever had, SPY, the spiders, right? That's a copy of the S&P 500 index fund. That was an index and very inexpensive, right? Fractions and fractions of 1% for a fee. Then the Qs, QQQ, which is the same thing for the NASDAQ, fractions and fractions of 1%. So in those cases, you're buying an index that's very inexpensive, and you have the benefits I mentioned a moment ago about being an ETF versus a mutual fund. But today, a lot of ETFs are actively managed, which means they could have fees in there, that are commensurate with mutual funds. So some of those newer ETFs actually charge more than traditional mutual funds. So you have to look through the ETF shell or the mutual fund shell to see what's invested in there and make sure that you feel comfortable with what you're invested in and you're comfortable with the fund's philosophy. Now, here's something really important for retirement income planning. ETFs and mutual funds can handle dividends and distributions differently. Now, with mutual funds, you typically have the option to automatically reinvest those dividends, which can be great for the accumulation phase of your investing. But when you're in retirement and need that income, many ETFs will just deposit those dividends into your account as cash, which actually might be exactly what you need or want for your monthly income needs. However, there's another consideration that's crucial for income-focused investors. That's tax efficiency, right? ETFs generally tend to be more tax efficient than mutual funds because of how they're structured. They can shed low basis shares more easily, which can mean fewer taxable distributions. This can be, particularly important if you're holding these investments in taxable accounts rather than in your IRA or 401k. Here's my take for most retirees. Don't get caught up in the bells and whistles. Whether it's an ETF or a mutual fund, what matters most is what's inside the wrapper. Are you getting the income you need? Is it sustainable? Are the fees reasonable? Is the investment philosophy aligned with your retirement income goals? Those are the questions that really matter, not whether you can trade it at 2:30 in the afternoon or whether it settles at the end of the day. Remember, successful retirement income investing is about consistency and predictability, not about having the flexibility to make quick trades during market hours. Hey, great questions today. If you would like to send in your questions, you can do so. You can email them to poollock@poollock.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.